Welcome back to the Accounting Working Group podcast. I'm your host, Dr. Sean Stein Smith, and I am thrilled today to have joining us on the podcast Olya Veramchuk, who's the Director of Tax Solutions at Lukka. And I'm really happy to have her today joining us on the podcast to honestly try to unpack and to analyze all of the trends, the headlines, and all of those other hot topics that are really occupying so much headspace right now for anybody from a individual point of view, investor point of view, client advisory point of view, as we all try to navigate, to unpack, and to actually give our clients the best advice possible as we try to, again, unravel some of these open items and questions that have to do everything to do with crypto taxation. Happy to have you here, Olya.
Thank you so much, Sean. Happy to be here.
And why don't you start by giving us some background on you and your firm and the services that you offer?
Yes, absolutely. So I'm Director of Tax Solutions at Lukka, which means that I straddle a really unique role where I collaborate heavily with our product team and develop new capabilities for our offerings. I also work closely with our sales team and help with any kind of directional tax thinking for our clients. And generally, just to give a brief introduction on what Lukka does, Lukka is currently serving Lukka serves the largest digital asset institutions through our software and data solutions. We help solve some of the greatest financial challenges in crypto and have the intellectual resources and data processing capabilities. All of our products are created with institutional standards, such as ACPA SOC controls, which focus on accuracy and completeness. And our customers include crypto asset exchanges and trading desks, CPA and accounting firms, funds and fund financial auditors, fund administrators, miners, protocols, high net worth individuals, and really any other business that interacts with crypto assets.
So I would say that it's pretty safe bet that you all are pretty busy these days, right?
Yes, we are.
And so building on that, right? What are some of the biggest hot button issues, hot topic issues that you and your team are currently facing, right? And I always feel that it's important to bifurcate between the individual taxpayers, investors, NFT creators, obviously, are a whole other audience, but the institutional side of crypto asset trading, custody, all of that. What are the hot button issues, hot topics, or biggest obstacles that you and your team are currently facing?
Right. So I think the world of DeFi continues to grow at such unprecedented rates and continues expanding and spitting out new offerings almost on a weekly basis, which means that all of us tax folks and really, frankly, data folks have to be kept on our toes to continue operating as efficiently as possible in the space. So, for example, in 2021, we've seen such a great expansion of different DeFi capabilities, starting with plain vanilla staking, going into all of the complex transactions related to yield farming and various other lending transactions. I think it is incredibly challenging from both tax perspective to analyze those transactions due to the lack of definitive guidance from the service. And it's also difficult from the data perspective to ensure that all of the pieces of the puzzle fit in exactly as they are supposed to fit in. And because there is that ambiguity with the tax treatment, our role is really to give our clients optionality with how they treat their interactions with the blockchain and what they do in DeFi space. I think as we see more institutional clients come into the space, the transaction complexity will likely increase, and we will see a lot more of the kind of traditional financial and tax analysis and planning that will go into those transactions. But then in terms of the hot button issues, I just can't help but mention the Tezos case that made so much noise in the last couple of weeks, right? Where just for the benefit of the audience who might not be intimately familiar with the case, the taxpayers had some staking rewards, generated some staking rewards a couple of years ago, reported them as ordinary income on their tax return, paid the associated taxes on that, and then they filed for a refund, because their notion was that staking rewards should not be taxed as ordinary income at the moment of receipt, but rather they should be taxed. They're analogous to mining minerals, for example, or growing an orchard or writing a book, whereby you should only be taxed on the products that you sell at the end. And so recently the IRS has reacted to the lawsuit that was filed and offered the taxpayers a refund. But however, they have rejected the refund and instead requested that the service provides guidance for all of the stakers out there, which is so needed. So we'll see how that plays out. That's definitely been a subject of discussions many times over the last couple of weeks.
And I'm going to piggyback off of, I think, 2 points that you raised that I think are quite interesting, right? That one, that the entire DeFi ecosystem honestly didn't really exist from an institutional point of view until about halfway through 2020, right? And so over the last 18 months or so, it has expanded so quickly and honestly become so complicated that, yes, to your point, that as more institutions get into DeFi activities, either offering them or actively being a part of them, that they are going to need more help on a compliance side, tax side, control side, all the rest. And then
we will absolutely be there for them for that.
Absolutely, 100%.
Yes.
No, and that whole IRS case, right? And I believe it's Jarrett versus the US.
That's right.
Yeah, and that is really interesting to me, because I can't tell you, I heard about it really, I guess at this point, as of date of our conversation here, I guess about 7 or 8 days ago, and it has been the only topic that I've heard on calls that I've had, emails, all the rest. And I do think that on the one hand, it's a great thing that the IRS is potentially, possibly reanalyzing how they treat certain crypto activities. But on the other hand, and I'm interested in your view on this, isn't it better to always advise caution, right, for taxpayers that are trying to basically eyeball this case and to use it as a template for all of these types of activities going forward?
Yeah, so first of all, they should not be doing that. The case hasn't even gone to the court yet, so there is no legal precedent. It's not binding to anyone. And by no means the offer of a refund should be viewed as the service's stance or a change of stance on how staking rewards should be taxed. This is just a signal to everyone that, and that was really clever actually on the Jarrett side, to not just take the refund and fizzle into the sunset, but instead request that the service comes out and gives us all meaningful guidelines, because there are so many people who are genuinely, they genuinely want to comply, and they just want to have the best and clearest guidance that's available to them. So, however, going back to your question, I think we need to see how this transpires. There is a period of time. So the court itself is not scheduled until 2023, I believe. But then there is the
Yes.
sort of the information gathering stage that is happening until mid-March of this year. And well, we'll see. Maybe if the service comes out and provides guidance, then perhaps the case would not even go into litigation. But as of now, from the tax perspective, it is status quo. So to any listeners, if you are staking any assets and you are generating those staking rewards, really at this point in time, they are still taxed in the same way as mining rewards, as in ordinary income at the moment of receipt at fair market value. Now, of course, taxpayers could choose to disagree and take a different view and different position, but that is entirely dependent on their personal scale of risk tolerance.
Excellent points there. And, to try to pop the hood more on this topic, is there any indication, right, to echo back to your comment earlier that as of right now, there is no sign that the IRS is in any way altering how it views crypto asset transactions? Is there any expectation, just anecdotal, obviously no hard evidence right now, but is there a anecdotal feeling or conversations that as crypto activities become more institutionalized, meaning that they are performed by institutions and are part of the general market banking landscape, is there a feeling that as that happens, that in and of itself is actually going to bring the IRS back to the table? And obviously, this is off the record. This is just your own personal view. It is not the opinion of your company. I don't want you to get into hot water. But is there any anecdotal feeling or hope that having these institutions involved is going to hopefully nudge the IRS in a more nuanced direction?
Yes, absolutely. And I think it's not just institutions, it's also the inflow of retail investors, because many people have been in the space for a number of years, but a lot more people have only recently joined. I think 2021 really has been the year when so many new retail folks started investing and trading digital assets. So institutionalization of the space would mean that there may be more powerful voices out there, more powerful organizations who would continue educating the regulators and helping the regulators understand the importance of providing the guidelines to the market players, whether institutional or retail. So I think rumor has it that we'll see something this year, but again, I don't really have any specifics.
And a kind of parallel point on that is that as institutions get more involved, and obviously the retail component is also going to drive hopefully positive change, as we've seen kind of sort of in the aftermath of GameStop and Robinhood, all of which happened about 12 months ago. But as more institutions get into this space and they have the, as you pointed out, the more powerful voices, the more resources, is there a sort of feeling, or are there conversations going on that there could be, that as the IRS becomes more, hopefully, right, more nuanced in their view on crypto, that actually that a more nuanced view could make life more challenging for firms like yours, trying to offer tax advice, tax guidance, all the rest? That on the one hand, it could be healthier for the ecosystem, but it's also could pose a operational challenge.
Right. Real quick on the Lukka side, thankfully, no tax advice is issued by us. We are a software and data company. So at least in that regard, I am out of the hot water, right? It's more relevant for, I think, law firms and the big four accounting firms, and other accounting firms, right, that do offer tax advice. But yes, I mean, of course, if, for example, at the end of last year, there were conversations about, there was draft language in the Build Back Better Act about subjecting crypto and digital assets to wash sales rules and constructive sales rules. That has not passed by the end of last year. So again, perhaps this will happen sometime soon, or maybe sometime during this year, or maybe not. But if it does, it will certainly create a number of challenges, to ensure that the product really aligns to the development in the market.
Well said. And to wrap up our conversation here today, which has been great, we've covered a ton of ground, and I absolutely have to have you on. I do want to ask you two quick questions.
Let's do it.
One, all right, what are your plans for the newly launched tax subgroup in the accounting working group? What is your goal for that and the mission of this new subgroup, which I'm super amped to have up and running?
Me too. I think we have such an incredible talent pool with a wide variety of backgrounds and decades of experience. And so everyone's thinking is very mature and extends far beyond the sort of crypto taxes 101, if you will. And I personally am in a unique position at Lukka because I see what our clients are doing. I'm exposed to this universe of client transactions. So the idea would be to bring those cutting edge use cases to our tax subworking group, and then debate the tax nuances with the masterminds. And again, maybe not necessarily with the idea of coming to a resolution or coming to a conclusion, but to offer a variety of perspectives and angles. And because we tax practitioners always evolve in our thinking, and our thinking always matures the more we spend time, looking at into the details and looking at those tiny niche transactions, which really could give rise to a variety of different issues. So I'm really hoping that we will achieve that with our WSBA Tax Working Group.
Absolutely, and I'm looking forward to it. Because as you outlined, there are just so many different angles on all of these issues that it actually can be difficult to even know what to ask, how to ask it, and then how to understand if you are getting the right answers. So I'm really excited for this subgroup to get up and running, and I'll be sure to keep all of you posted on all of the webinars, events, and all of that coming out of this new working group. And then one last item here, putting you on the hot seat, because I always do this to everybody, and it probably is not a fair question now. But I'm going to ask you, and if you can't answer it, fine. But your year-end price target for Bitcoin, because I have to ask that question of every guest.
Right. Well, so I've seen some speculations about about Bitcoin going to over $1 million by 2030. Within this year, if we get to 100,000, that would be great. But I personally am really rooting for smaller players like Terra and Cosmos. Yes.
All right. So I will end it here then. Oh yeah,
sounds good.
It was an absolute pleasure having you on the podcast. I will definitely have you on at least once more during the year. And everybody, have your eyes peeled and ears open for the content, podcast, webinars coming out of our new tax work group. Oh yeah.
Thank you so
Pleasure
much,
having
Sean.
you on. All right,
Have a good weekend. Bye.